let us come to the last part, and after that we'll take question and answers. Uh, uh, Technically, I think what we've kept as per the O'Neill methodology, if all fundamentals are clear, and if all technical aspects are also clear, and if there is certain changes in the market condition, right? Managing risk and managing your capital is something that we also pay a lot of heed to. A lot of people probably do not pay heed to that, but it is an extremely important portion that you need to. A 7 to 8%, you may ask me why? Because we've done a lot of studies at the back end. William O'Neill himself studied the US market for a long time. We studied a lot of back-tested operations across market cycles in the market direction that I was speaking about as well. And unless we're in a downtrend where we avoid purchases, right, or an uptrend under pressure, we are more concentrating on selling, where the rule comes into application, where 50 DMAs, 200 DMAs are taken off. There are no questions asked, right? In certain cases where stocks you are actually holding need to let off. But in other market conditions, which is in the confirmed uptrend, if the stocks are giving away, right, 7 to 8% from their purchase price, and we've studied these stocks in market conditions, specifically in the confirmed uptrend, it is not a good sign, because there is something which is probably happening with the sector, with that stock, even if it's a leader. That is probably giving away. Institutions are coming and selling and dumping that stock because of certain changes, regulatory, compliance-wise, maybe something related to the company in question as well, which is causing a cause of concern. And therefore, if it comes off, I think what we backtested in terms of our previous confirmed uptrend and market conditions and leaders giving away, you should get away, no question asked. What happens is, I think, let's look at an example of RBL Bank. Fine uptrend, asset quality was still okay, but what probably happened a few weeks later, as that stock started giving away, right, in terms of its moving average, with extremely heavy volume, we got away, we took out our profits. What happened over the next few weeks and months was and testimony in terms of what we probably laid out. So again, I think technicals during selling, huge importance on fundamentals along with technicals when you are entering that stock under consideration. The flip side of that argument, as I was saying, right, Titan, it started moving higher and higher just before it had given its guidance that the quarter will be a little bit weak when it came to November 19. This is November 19's chart. But this movement on the upside was happening with extremely low volume. So this is again a cause of concern. If stocks are making newer highs on lower volumes, as is indicated on these charts, they are a sign of worry, because what is happening is institutions are pulling away. Retail investors are getting sucked in while institutions are distributing their stock. Their guidance actually came through, and their guidance in this periodicity, when the actual result came through, was actually worse off than what they had given. And it actually breached off its 50 DMA, directly gapped down on this day. What I mean by gap down, it never really gave a chance to investors. At 9:15 when the markets opened, it directly opened up 7 to 8% lower. It consolidated for a few days, but look at those volumes when it gapped down. And then over the next few days, with good volumes, which is a little bit below average, but again good volumes, it broke its 200 DMA, which was the nail in the coffin. It took some time for that stock to recover in the next few weeks and months itself. But I think these are some worrying signs that you should probably get away. So if you're earning reasonable amount of profits, you need to book your profits periodically. Watch out for all these signs that I said in terms of the market direction, how the index is placed within the market direction, and how stocks are placed within this entire perspective itself. If you're making a reasonable gain, and if the market direction is turning for the worse, if the indexes are giving away, specifically the main indices, the sectoral indices are giving away, certain stocks are giving away very, very significantly, you get off, because there is something which the markets knows more than us into the consideration as well. Again, I think you should probably be trailing, right? So in certain cases, you take most of your profits, but if the market is in a fine uptrend and it is above its moving averages, you keep on monitoring that stock under question, and whether it does not reach its key moving averages and the stock direction and the market direction is not turning. So till that point of time, you can just keep on trailing, and your moving averages will keep on moving higher and higher. So just keep your trailing or averages to the nearest moving average for these stocks, and look at the overall market contextuality in consideration as well.